Welcome back to my channel. I am the covered call guy, and yes, we're going to be talking about spin ETF, the smartest covered call ETF nobody is talking about. Oh, perhaps I probably shouldn't have said that. Perhaps somebody did leave it in the comments or in a different video and I might have missed it. But before we get started, legal disclaimer: this content is for informational and educational purpose only and should never be considered financial, investment, or tax advice, because I am not a licensed financial advisor, investment professional, or tax expert. All opinions expressed are my own and may be inaccurate or incomplete or just flat out wrong. So please always conduct your own due diligence and consult with a qualified licensed professional before making any financial or investment decisions. Remember, guys, I am just some random clown you found on YouTube, and I could be completely wrong. I could be completely wrong about this ETF, but for my research, it looks pretty solid. Okay, the question here I'm going to ask you guys is, have I been sleeping on spin, the spin ETF? Okay, it looks like this is the hidden evolution of cover call ETF. It's officially here. It looks pretty. The strategy looks pretty, not newish, with a little blended of something I do like from my other holdings, and you guys will get to see what that is. So I'm going to be breaking down exactly why this fund might change everything. Okay, I just want to put a disclaimer here. I cannot remember if anyone has actually mentioned this, but I do know a lot of y'all were trying to get me on State Street. So obviously it's always been on my watch list, and I checked up on it again, and this piqued my interest. This is where I saw spin from. I was just looking at State Street, and a lot of people started commenting, hey, you should look at State Street, which I've known about. So your boy might drop around 10K on this for fun to see how it goes. So I might drop like $10,000 when I can on this and just see how it goes and how it turns out. So all right, let's get started. All right, so the yield chasing trap. So over the past decade, you and I have watched investors blindly chase massive yields, right, while refusing to give up equity exposure, at least those who have been investing for a while. Okay, the industry solution was covered call ETFs. Welcome to my channel. I am the covered call guy, and you know, if you're trying to find a solution, you came across my channel, welcome. If you're new, please leave me a subscribe, help the channel grow, right? But this came with a fatal flaw, especially with these Gen 1 that I talk about, Generation 1. And Generation 2 does have some of the flaws still, but a little bit improved. And then obviously everybody loves the new Gen 3, which is the Neos, right? All right, so why did everybody come to cover call ETFs? Well, because they paid massive dividends or distributions, right? It was the great yield, right? While slowly bleeding your initial capital dry. So, you know, these were the the QYODs, these are the yield maxes, these are the REX, these are the what else did I miss, right? And some of the round tail, you have to be very, very careful, right? These could be the leverage, right? So this is the brutal reality of NAV, right? Net asset value erosion. That's what we call NAV erosion. Okay, so look, the problem with dumb income is that most legacy cover call ETFs operate on a purely passive mechanical basis, right? It's just the rule base and they just kind of pretty much they have set rule and that's it. They don't change it, right? They blindly, which leads to blindly writing at the money options every single month, regardless of what the economy does, right? That's not good. Regardless of what the VIX does, right? So if the market crash, the premium isn't enough to save you, and it rips higher, your upside is completely capped, right? That's what we call the dumb income, right? The dumb income of cover called ETFs, right? Because it completely sacrifices all of your upside for a fixed premium, and you take all of the downside risk. Well, enter spin ETF. The target monthly yield, it should annually here. I think I've mistyped this. This is annual. This is the target yield of 8%. All right, so typo here, not target monthly. That would actually be insane. So typo. Okay, see, I could be wrong, right? I let you know my legal disclaimer here. I'm already messing up here. The target annual yield here is about 8%, right? Not monthly here. So hopefully you guys are not just reading and you guys are watching this with sound on. Okay, so besides this, I think everything else looks good. Launched in September 2024, so pretty new by State Street, so one of the big fours, right? The spin ETF refuses to compete in this toxic yields arm race, right? That's what their prospectus is showing me. I'm loving it. I've read up on it, unless I've read something wrong. Perhaps somebody out there that owns this or perhaps wants to get into this, let me know if the prospectus is telling you what I'm reading here. As a 0.25 expense ratio, oh my god, very excellent. This is very nice. And a monthly yield annual yield around 8%, right? That's what they're targeting, 8% yield, not monthly. I should all right, just let you guys know, that is wrong here. Okay. So, but it is new, and it does sit at a tiny $57 million in assets. Okay, it isn't trying to maximize your income at all. That's what I actually love about this. Yes, we are income investors, but remember, you do have to have some of your portfolio kind of for growth tilted and then income second. Okay, instead it is mathematically engineered to balance your cash flow, control volatility, and preserve your capital. Guys, if you're new to this channel, we are all about long-term, sustainable, with reliable and consistent payouts. Okay, now if they're trying to balance your cash flow and control volatility and preserve your capital, right, you're most likely going to see a fluctuation, but you are going to be able to hold this long term. And if you don't know anything about me, I am in my mid-30s, okay? And I intend to try to live off my income for the next 40, 50 years. So this is something I'm really looking at right now, okay? So let me know if it has piqued your interest already. All right, so step one, the active equity engine, okay? So Spin's foundation isn't a lazy passive index, okay? It is a actively managed portfolio, about 90 to 100 US equities. Okay, the managers rigorously select companies based on strong fundamentals, robust cash flows, and sustainable growth. So what does this sound like already? To me, this sounds like an actual, like a stronger, more resilient active management SCHD. That's what it sounds like to me. This sounds like an actual SCHD that pays monthly, has active management, and can double the yield of it. So it sounds more of like a synthetic type of SCHD. I could be wrong on this, but that's what it's looking like to me. Okay, right now they are heavily favored tech giants like Nvidia and Apple. So of course SCHD doesn't hold any of that. So it's kind of like, you know, you have to have some tech in there to manufacture the yield, right? Alongside financials like JP Morgan, aiming for an organic 14.17% earnings growth rate. So that sounds like they know what they're trying to do here, right? Growth, preserve the capital, give while doing that, pass off some income and control volatility here. Okay, so this fundamental correlation is our primary defense, right? The very defensive against natural drag of covered calls. Okay, so it look like they're doing great here. They're choosing well. All right, so what is step two? Step two is how they're playing and creating these premiums is the flex options overlay. Okay, so institutional execution here. All right, they're using flex options. So instead of writing options on individual stocks, Spin writes customizable short-term calls on the S&P 500, right? So they use an institutional grade flex option cleared through the options clearing corporations. Not, you know, it's not going to be made for us retailers. All right, these are going to be the big banks, the hedge funds, or, you know, the big ball players here. All right, so total customization. So this means they can completely customize strike price and expiration date, neutralizing the risk of early assignment. All right, so I want you to realize that Spin's true edge isn't just a strategy, right? It's this precise institutional execution they have. Okay, so they have complete total control. All right, the macro aware secret weapons. What does that even mean, right? So here's where Spin attempts to solve the biggest structural problem in the entire category, right? The cover call ETFs. Instead of a static override, it uses a proprietary macro aware dynamic strike selection engine. This means they have their secret model. Okay, I don't know how secret it is. Perhaps they're just saying it is, but this is their intellectual property, right? This is the model that actively decides how aggressive the calls should be based on real-time market fear and greed. It just sounds like they have their own in-house built AI doing this, okay? So in essence, Spin is not just a strategy. It is a discretionary decision-making framework wrapped inside an ETF. Okay, so how dynamic harvesting actually works. Okay, so this is split into two, and this is my opinion on how I think it actually works with Spin. Market panic, right? High volatility. When the market panics and the volatility spikes, option premiums become incredibly expensive. Okay, Spin's model react by selling option closer to the current price, intentionally harvesting massive income to cushion your downside exactly when you need it. What happens in a bull market? Low volatility, right? Well, conversely, during calmer bull markets, it writes option much further away from the current price, right? out of the money. By accepting less premiums, it does raise your ceiling and restore your upside participation. So guys, let me in the comments down below what you guys think this strategy is already using, because I can already think of two. I like it so far. I don't know if you do, but I like it so far. Okay, synthetics versus organic yield, because this is very important, right? We got to ask ourselves, do we want the synthetic or organic? Well, look at this here, right? 7.5 is a synthetic options and 0.6 organic SEC yield. Okay, so it's not too crazy here. We need to do a forensic breakdown of SPY's 8.1 distribution yield, right? Because the truth might surprise you. The SEC 30-day yield, which is the actual organic corporate dividends paid by stocks, is a tiny 0.6%. Well, that means the vast majority of the cash hitting your account is synthetic, right? Income generated by selling options here, and it is manufactured yield. Okay, Spin intentionally restrained this yield to 8% to ensure the option drag does not destroy your principal over time. And this is very important. All right, so the brutal trade-offs, right? There is no such thing as free lunch. Okay, so what is the trade-off here? Okay, if you're new to the income space, this is going to be new to you. And honestly, if you've been with me here for a while, you've been subscribed, right? You know what I'm talking about here. One, the upside capping, right? I'm gonna be brutally honest with you. This is the trade-off here. There's almost no guaranteed of any covered call ETFs that generate income that's not gonna cap you to a certain extent. You're gonna get capped, right? It just depends on how much you want to get capped, right? Closer to at the money, further out the money, overrate strategies, right? So cover calls cap your upside during explosive market rallies, and Spin is no exception. Yield disadvantage, and right, furthermore, this is an 8% yield. It's going to look uncompetitive next to a 12 or 20% yield offered by more aggressive peers like SPY or Yield Max, right? If you're a Yield Maxer. Flex risk, okay? They use flex. This is it. Also, liquidity and counterparty risk, meaning banks can fail, right? Because those customized flex options are less liquid than standard retail options, okay? There's more of us than there are of banks, okay? So the reality, you have to accept that you will underperform a raging bull market here, okay? You're just going to have to. There's no other way. This is the cover called structural baseline for all cover calls. Hey, model risk, the invisible variable. Okay, so to perspectives, if I read it correctly, if I understand it correctly, quietly issues a massive warning about macroeconomics misinterpretation risk. Okay, because Spin relies entirely on its proprietary macro signal, is probably this AI they have, right? You are exposed to extreme timing and regime classification risk, right? If the model is wrong and misreads the economy, well, the entire edge of this fund instantly disappears, right? Kiss it goodbye, right? It is a fragile edge that depends entirely on internal model accuracy and how well these fund managers read it and interpret it and agree or disagree with it. Okay, so this is the $55 million advantage, if we can see it as an advantage. For those who are new, I don't like buying a fund under $100 million, right? I want to see it cross the $100 million mark. That's when it enters the big boy arena, okay? So anything under 100 does have a higher chance of liquidation, and Spin is no there's no exception to Spin, right? So this right now, they are in the incubation phase, right? They are trying to build up. So with only $50 million in assets, right, Spin is firmly in the incubation phase, which actually does give it a macro structural advantage now, right? Operating with a small asset base does allow the manager to quickly execute these custom flex options and pivot positions without causing market slippage. Okay, so it does have to time properly. Because it's smaller, it does execute a little bit better, right? The agile execution, right? I do believe Spin will perform at its absolute best right now before it becomes mainstream and bloated, because the bigger it is, the harder it will be to win, right? But small enough to carry out closure risk if it fails to attract money. All right, so the hidden scaling trap. All right, nobody is talking about what happens to Spin when it eventually does hit the $1 billion in asset, right? So at a more massive scale, when it does grow, right, it becomes exponentially harder to customize the flex options precisely and maintain dynamic positioning without heavily moving the market. Because the more money they have, obviously, they're going to be controlling the pricing and they're going to be pushing pricing upwards, right? If this fund gets too big, right, there's going to be a severe risk that the strategy will be forced to become more mechanical and less adaptive, right? Spin's incredible advantage is highly conditional on its current size. It's just the way the math is. The more money you have, the more money you're going to spend, the more money you're going to be pushing onto the market, right? You can just, that's just basic market here. Right, so the ETF ecosystem, right? Spin versus the Titans, right? So I put it against Yield Max, JEPI, SPY. How does it perform? Well, if we compare to the Titans, Yield Max carries extreme risk of NAV destruction. JEPI is a behemoth but lags in growth, right? While SPY offers the best tax-efficient passive overriding, Spin sits perfectly in the middle ground right here. That's where I think Spin does best, right? Trading tax efficiency for fundamental stock picking and macro timing, right? So they sit right in the middle with the yield not being too bad, is matching JEPI, right? So the way I see it is like more of an institutional JEPI 2.0. So if you love JEPI, you might like Spin even better. Okay, the tax reality, right? Section 1256 versus the 1234. What do I mean by this? We have to talk about taxes always, because SPY uses Section 1256 contract to give more wealthy, higher income bracket better tax breaks under 12%, right? Spin, however, does fall under Section 1234. I'm not a tax expert, not a tax accountant. Talk to a qualified one. I could be wrong on this. What I think this means is its option premiums are taxed at your ordinary short-term income rate. So this is going to be an issue because at 8% yield, right, it does drag it down perhaps to a more like 6 or 5.5. Okay, if you hold Spin in a Roth IRA, then this wouldn't matter. But if you hold it in a taxable brokerage account like I might, you must carefully plan for that ordinary income tax hit. So be very, very aware of this, guys. Okay, exploiting your yield chasing psychology. Okay, I just want to put this out there. Most retail investors are chronically addicted to immediate cash gratification, especially if you're new. You're going to see, oh my God, I just need a little bit of this capital to get this much every month compared to a quarterly payment with a 2% yield. Of course, right? When you go for 2% yield to 10, 15% yield, it hits you and it just drags you in, right? This is called blindly buying 26% yields while ignoring the collapsing principal, okay? Spin possesses a very distinct behavioral edge precisely because it exploits that psychological weakness. It is structurally engineered to be boring for yield chasers, but structurally superior for long-term compounders, right? It acts as an automated guardrail to protect you from your worst impulses, okay? And everybody falls victims to this, including myself. All right, let's look at how we can build a golden age portfolio, right? Tier 1 is pure growth, right? These, what I can say here is don't rely on the dead 60-40 bond mix, right? 60% stock, 40% bond, right? Use VU or QQ for uncapped growth. This is where, you know, this is tier 1. These are always going to be the best of the best. Your long-term horizon where you don't need the income, this is the best. Tier 2 is the stabilizer layer, right? This is where I say again, Spin belongs here. This is where you kick off an 8% yield to pay off living expenses and don't want to crash without selling your tier 1. And then tier 3 is your liquid defense, right? Obviously, you know, use SGov for absolute liquid defense and capital preservation. This is, you know, your T-bills, your high yield savings account, wherever you want to put it. But that's where I would say Spin belongs. It's very good at stabilizing. This is how I'm reading off the prospectus and how they're executing. And it looks pretty decent. I like the way they are executing, and I like the yield. I like the strategy. It makes me, I feel very comfortable with them right now. So I might have to put, like I said in the beginning, I might have to throw down $10,000. I might. I'm not probably going to do it right away. It is on my watch list, and I'm keeping an eye on this. All right, so it got cut off. But the adaptive income engine thesis is that, look, I just want to let you guys know, Spin represents true evolution of covered call ETFs. I really think they are actually changing the game here, moving us away from complete static income extraction to more a dynamic volatility harvesting. I like what they're doing. I like it. This is pretty good. All right, it increases your income when markets are stressed, and then it gives you back your upside when markets are calm. What does this sound like, guys? I made a video on this just before this one. Guys, what am I talking about here, right? Spin isn't trying to pay you most. It's trying to make sure you don't blow up while getting paid. I like that. Okay, you don't pay me. Don't pay me when the markets are not giving you, when you're not making enough, right? Preserve my capital. You know, for those who are new, you should always be aiming for a 20% buffer. So if you need $3,000 a month to live, you should be aiming for at least, 20% of that, right? An extra. Well, maybe not 20%, maybe even more, right? Maybe even 50%, right? So maybe 4,500. And if you want to be even, feeling a little safer, $5,000 a month, right? That way you have that buffer when times get rough. Because if you get $5,000 a month, but all you need is $3,000, right? You got the extra $2,000. You should always be doing that. I don't need to say that. You guys have common sense. You guys are a bunch of smart folks. All right. So who should buy this and who should run? In my opinion, the buy case. If you demand balance of income and growth, or you're a refugee fleeing the NAV erosion trap of high yield funds, SPIN is absolutely for you and for me. All right, because ultimately True Wealth is built by aggressively protecting your downside while harvesting volatility over the long term. Guys, we are always about the long term. All right, all my subscribers are all about the long term. We don't want anything short term, right? Well, why do you want that headache? I don't want that headache. At the end of the day, when I'm done, when I'm retired, I want all of my subscribers to be on a nice yacht with me, enjoying the beach, the sunset, sipping on some nice whatever you guys want. All right, the run case. This is not for you if you're the more aggressive yield chaser demanding at least a 20% payout, or a short-term trader trying to time the market. This is where you stay far away, right? SPIN achieves this superiority precisely because it is intentionally restrained, right? They hold themselves back, right? So hopefully you guys got something out of this. It was informational. Perhaps this put this new ETF, you never even heard of it, on the map for you. If it did, again, subscribe, comment, like, because it I definitely have it on my watch list, and I am looking at it right now. If the market flips, I want to see how it changes. I want to see how it recovers. All right, I'm not really too worried about buying, missing out on the dips and buying low, because at the end of the day, I'm buying for a 30-40 year time frame, so it doesn't really matter to me. But I do want to see how it recovers. So before I drop the $10,000 out of nowhere. So again, thanks for watching, guys. You guys are the best. And let me know if you guys own this. Let me know if you guys own it and you're very, very happy with this. I'm very interested in this, okay? Thanks for watching. Stay tuned. Catch you guys in the next.